In this video, we're going to be talking about three dividend stocks that I just bought. We'll go over how much I bought, how much annual income they will be putting into my portfolio. They are all current positions that I do own. I am adding more money into this portfolio. We will be looking at everything. I'll go into an analysis on why I'm buying these stocks. 2 of the 3 are actually very discounted in my personal opinion. But remember, everything I say on this channel is not financial advice. It is all my personal opinion and for educational and entertainment purposes only. But enough of that talk. So before I go any further in this video, all I said, if you enjoy it, you make sure to give this one a thumbs up and you subscribe. You turn on those post notifications for videos coming out every other day. I'm trying to give out the best information I can on dividend stocks and passive income. You can check out this portfolio if you want to. Link will be in the comments or description below. It'll say dividend portfolio. You can take that link. It'll take you to M1 Finance, which is the broker I use. And if you want to, use that link in the description and comments below where you can get a free $30 by signing up and depositing $100. Yada yada, you know the way that it goes. But enough of that talk, let's get into these 3 stocks that I am buying. So here's a little track of all the stocks that I bought. The tickers are XYLD, Vichy, and MO. So we'll see right here is I bought 14.81 shares of XYLD at a price of $50.65 per share. The XYLD currently has a dividend yield of 9.11%. That cost me $750.13, and now that will be providing $68.28 in annual income. Vichy right here, as we can see, I bought 11 shares, $28.74 per share. The dividend yield on Vichy is 5.01% and an average cost or total cost of $316.14. The annual income that I'll be getting from this new position or this new addition onto my current position is $15.84. And ticker MO, I bought 4 more shares at a price of $44.92. The dividend yield is 8.01% and the total cost is $179.68. The new annual income with this addition to my portfolio is $14.40. All the totals, the total cost, grand total cost was $1,245.95. And the total annual income that I'll be receiving from these new buys is $98.52. Remember, that does not sound like the most amount of money, $98.52 on an annual basis. You might be like, why are you spending all this money? But think on a long-term basis, okay? Think very long-term. That $98.52, I'm not pulling that out of my portfolio anytime soon. This is going to be reinvested right back into these companies, and XYLD is actually an ETF. And it'll be reinvested into these investments. And what's going to happen next year, the next time that these pay their dividends, which XYLD is monthly, so it'll already start going, the dividend snowball is going to be getting bigger and bigger and bigger. But let's talk about why I bought these stocks. So first up is Altria Group, ticker MO. As we can see, they trade at $44.92, and over the past 6 months, they are down 10.54%. What Altria Group is they are the parent company of Philip Morris, John Middleton Inc., U.S. Smokeless Tobacco, yada yada. Pretty much what they do is they work on tobacco, cigarettes, and related companies like that, alcohol, cannabis, and they're in some big markets. So what we'll see right here is that they have an annual payout of $3.60, a payout ratio of 78%, a 5-year growth rate on their dividend of 8.59%, and dividend growth of 52 years. They kind of came out with some earnings, and they are kind of decreasing how much they expect to make. They're raising their lower end of our full year 2021 guidance and now expect to deliver an adjusted diluted EPS in a range of $4.58 to $4.62 per share. This range represents a growth rate of 5% to 6% from $4.36 in 2020. So what they did is this came out in October 28th of 2021, so about 2-3 weeks ago, and they are having a massive share repurchase program of $3.5 billion. They expect to get this done by December 31st of 2022, and in August they increased their quarterly dividend for the 56th time in the past 52 years, which is incredible stuff. Altria maintains its long-term objective of a dividend payout ratio target of approximately 80% of its adjusted diluted earnings per share, which is incredible stuff. So what we'll see right here is that they had some falling pressure in their earnings, and the company's quarterly performance was affected by lower shipment volumes in the smokable and oral tobacco categories. Nevertheless, higher pricing continued to remain an upside. The company's wine category witnessed growth in the reported quarter, Management announced an expansion to its existing share repurchase program. It also raised the lower end of its adjusted earnings view for 2021. So, the company did not produce the earnings that were necessarily expected or the revenue, but what that caused was the stock to fall. And so I am thinking very, very long term on this. And I believe right now is the perfect time to buy because I want to get my yield on cost of this company. And with the potential that there is, with an 8.01% yield, and I believe that the value is there currently is $52 fair value on the stock. I believe this will be getting me a whopping double-digit yield on cost for this stock. Some more things that make me like the company is that they are trading below their intrinsic value of $252, which I'm not saying that MO is going to be $252. Don't get me wrong, it could very, very far down the road. I'm not saying it's impossible, but most likely it will not happen, but it shows that the intrinsic value is there, and their earnings is they have good value based on its earning relative to share price of 30.35 compared to the market average of 37 and compared to their total industry average of 39.44. Some more things that I really like is Altria. New U.S. tax proposal would protect cigarettes, rating this a buy. So what came out is a new proposal that would have huge tax increases for e-vapor and nicotine pouches, but no change for cigarettes and moist snuff, which would make Altria Group a clear winner. This great dividend stock that I really, really am liking. The earnings per share is increasing steadily ever since 2008. You can just see this nice uptrend on the stock. But that's my analysis on MO. Let's talk about the second stock on the list, which is Vichy Properties, ticker VICI. This is a REIT, and they are down 7.86% over the past 6 months. And over the past month, they're down 4.42%. They own a lot of properties, but mainly like casinos. If we want to see their entire portfolio, here are some things they own, like Caesar Palace, Harrah's Las Vegas, and the list goes on. They actually own some big-time golf courses as well. They have a massive portfolio, and they have a lot of upside potential. They have a payout ratio, it says on Seeking Alpha, of 78.23% and a dividend yield of 5.01% and dividend growth record of 3 years. So this article right here that we're looking at right now is talking about inflation and some good hedges against inflation. And it says that Vichy Property is one of the two that they suggested. So usually you don't want to go with people who have really long tenant leases, but Vichy Properties is an exception, and here is why. The weighted average lease term on Vichy is 43.5 years. But here is kind of why they're suggesting that Vichy is a great buy with expected high inflation over the next few years. So what we're seeing is fixed rent hikes plus CPI adjustment. Practically all of Vichy's leases include annual rent hikes that average nearly 2%. And on Caesar's lease, which is 40% of their total revenue, they can grow at greater 2% and with no cap. No property expenses or capex, so all their tenants are fully responsible for any expenses that they have. So Vichy is protected from these insane expenses that could come across them, and a minimal risk of vacancy. Since they have really long leases and different things like that, there is very low risk within the fact that they will have vacant buildings and stuff like that, so that this cash flow will continue to come in. So as such, Vichy is very well protected against inflation and has managed to grow its dividend by 20% since the beginning of the pandemic, far exceeding the rate of inflation, all while paying that 5% dividend yield. Furthermore, it is priced at around 13.5 flow from operations, which compares very favorably to the average REIT sector, and they expect it for Vichy to keep growing their cash flow to 6 to 8% per year, all while paying that 5% dividend yield, which would result in double-digit annual returns. In addition to that, it has an extra 30% upside from repricing at a higher multitude in the coming years. Looking on some more things, they had some lower fund from operations money coming in, and that is why the stock is down most likely over the past few weeks. So what we'll see is that their adjusted funds from operations per diluted share of $1.79 to $1.80 for 2021 declines from their $1.82 to $1.87 in the prior review. Income from lease financing and loans of $70.21 million in Q3 increases from $52.83 million in the same year-ago period. But this is where things got kind of spicy. Is Q3 flow from operations per share of $0.28 versus $0.74 in Q3 of 2020 is a big concern that struck investors. and the year-over-year decline was primarily related to a $334 million one-time gain upon lease modification that occurred in 2020 and a pretty much $80 million loss on extinguishment of debt and interest rate swap settlements in the quarter ended September 30 of 2021, so Q3 of 2021, and these changes were partially offset by a $168 million decrease in the change of CECL allowance for quarter ended Q3 of 2021. So there was some new outlooks coming out for the stock and the company that maybe struck investors, but on all these three investments, I'm thinking very long term, a multitude of years that I believe these stocks can provide. As we're seeing, the revenue on this company, though, is slowly increasing steadily and steadily, very, very uptrending, which is what we like to see. And the same thing goes is that Vichy is trading below their intrinsic value, and their value based on earnings relative to share price is way better compared to the U.S. market average and the REIT average, which is very good, saying that we are buying this stock on a discount. But let's talk about the third stock, which is actually an ETF that I am buying and why I just loaded up, which is XYLD, Global X S&P 500 Covered Call ETF. Over the past 6 months, they are up 5.26%, and over the past month, they are up 0.5%. They have a whopping dividend yield of 9.11% and a 5-year growth rate of 20.77% on that dividend, with a dividend growth record of 2 years. But they have really only been an ETF for about since 2013. So a little bit newer, and whenever COVID happened, that's whenever the dividend cut kind of happened. But they are still paying these dividends on a nice, consistent monthly basis. Looking onto some more stuff. What is XYLD? They track an index of S&P 500 stocks and sell 1 month at the money call options on up to 100% of each stock. So what they do is they own a bunch of stocks in the S&P 500. We can look on their top holdings, and their top holdings consist of Microsoft, Apple, Amazon, Google, Tesla. You see the big companies, and then they'll sell covered calls on them, collect the premium, which is they're pretty much trading options, but they're not doing it in a risky manner. And then they collect that income and they pay it out to the shareholders with an expense ratio of 0.6%. That's how they make their money from us, but we get their money from their operations. But that is what I have for you guys in this video. So if you did enjoy it, make sure to give this video a thumbs up and you subscribe. You turn on those post notifications for videos coming out every other day. I always like to see what you guys are doing, what you guys are thinking. Thank you for making it to the end of the video, and just a big thank you for all the support the channel's been getting. The views are crazy. The channel's growing at incredible rates. Thank you so much. Check out M1 Finance if you want to get free $30 using the links in the description or the comments below. And I will see you at the next video.